Hi guys, to be with you. Hope you've had a and let's sorry, my apologies. My apologies about that. I think my network played up a little bit there, but we should be fine. So I was saying I hope you had a profitable week. And the concept of having a profitable week is so the title we have for this particular session is losing trades. They do two things. If you approach them with the right mindset, if you have losing trades, you need to analyze your losing trades. If there is something that you really ought to spend a lot of time on, it's two things we are regularly. At the end of every trading session that you're in the market, or if you've been out of the market for a reasonable period of time, you always need to get familiar with what the market is doing. So chart analysis is a discipline you have to get into. Whatever time frame you're trading, at the end of your session, have a look at the charts and ask yourself what happened. And I'm assuming that we all like trading. I'm a big fan of live trading. Rather have a small account that you trade live, so you can get into the real emotions of being in the market and experiencing what the market throws at you. The whole psychology that goes through that is pretty exciting. So first thing is chart analysis. Fundamental. You have to love your charts, and you just have to put in an immeasurable amount of time in chart analysis, but do it purposefully. And when I say do it purposefully, do it to identify your strategies. So you should have your strategies well defined. So you look at a chart, there's all this fantastic price movement, and there's, wow, my goodness, if I'd been in the market today, I would have made so much money, because it's at the end of the day or end time period that you're looking at. But don't get caught up in that. Get caught up in searching out and saying, where did my strategies come to? Where did they materialize? And how would I have traded them if they occurred while I was there? Then it's good to look at winning strategies, at winning trades. Fantastic. I'll talk about that a little bit just as we go past. But losing trades are really the source of growth and development. From my own experience. And why do I see in? We look at the charts as we go along. As the focus is not that I'm going to trade that I have taken. And if it's the first time that you're doing it, don't months. Just go back to two types of losing trades. Okay, two types of losing trades. So just bear that in mind and be very serious with yourself. Be very strict losing trade. In one column, out of those 10 trades that you looked at or whatever number of trades, you want to identify losing trades that you took in strategy. In other words, they are part of your defined strategy. So you took the trades, and you ended up losing money. So out of this bucket of trades, one column, trades that are lost, but they're in strategy. The other type of losing trades is trades that you took that are out of strategy. It doesn't matter how much, how appealing it was. If it is not part of your strategy, put it in that bucket. Okay, and then we'll look at what we do with those. So for now, when you do the exercise, get your bucket of trades, just go back 10 trades. You can go back more if you have the time, and separate them into trades that were in strategy and trades that are out of strategy. Then out of 10, using 10 is just a number. Right up front, what percentage of the losing trades were in strategy? And then the remainder, of course, is out of strategy. So if 60% of the trades you lost were in strategy, 40% would be out of strategy. That's a very important number to keep in mind, because what you want to do, your goal has to be that out of a bucket of losing strategies, the bulk of them, the majority of them, you want your losing strategies, your losing trades to be trades that you took in strategy. That's the goal. If it's weighted the other way, if you are losing more trades which are out of strategy, even if it's 50-50, you've got some work to do. The goal is to ensure that you're losing strategies way more on the scales of in strategy. Ultimately, when you really get good at your game at following your strategies, all your losing trades will be on strategy. That's a long-term goal. I look at my strategies and I look at it and I say, why did you take that? I do that, and the way I manage myself, now more of my strategies are more of my losing trades are in the bucket that's in strategy. And I have a very simple mechanism of managing myself. When I am trading, when I'm actually in the market and I'm executing a trade, I just have to play this little refrain in my mind, remind myself, is this a strategy that I will teach to my son or my daughter? If it's not, then I can't take it, because my strategies that I've written down are crystal clear. I can talk to you about them. I can talk to my daughter about them and just say, listen, when you come back from school, just take an hour, just look at this chart. If you see something doing X, Y, Z, just give me a shout and I'll come and execute the trade. That's taking a strategy that you can talk to your child about. If you don't have a child, can you talk to your mother about it? Can you talk to your friends about it? Why did you take the trade? If it's not in strategy, you can't teach to anyone. Bite your fingers, do whatever, don't take a trade. Okay, so let's just park that for now, and let's have a quick look at what we got happening in the market very quickly. Okay, so guys, for the sake of guys who are following my approach, if it's your early days, very quickly, what I always do, I have what I call a daily setup, and I don't change it. Today I was in the market during the Asian session with a few good trades. So good trades. They were in strategy. I think there were 6 trades. I was stopped out of 2. Well, I stopped myself because I managed myself out of the trade, and I made profits on the other 4. So 4 or 5. So I'm happy with that. But the setup is the same setup whether it's in the Asian session or you come in just into the European session or you come in to the American session. This red horizontal level marks the low of yesterday, and the green horizontal is the high of yesterday. Green buy, red sell. So that's the logic behind the colors. And the purple magenta line is the open of the day. very critical for me to always have that. The other thing that I can show you just quickly, we're not going to go to time. If we do, we'll get back to it. I want to show you the gold of daily, because it's something I spoke about a couple of weeks ago, which I think on the daily time frame is quite interesting. If I see these blue dotted lines, horizontal lines, what it says to me is that when I do I would run at the beginning of the month, and I look at it once a week. When I do my higher time frame analysis, I know there is a level of resistance that's in a higher time frame. So if I see this coming, I know this is significant for daily traders or weekly traders or monthly traders. So I have to pay attention to it. So that's what those blue dotted lines are. But in terms of where we are, having a look at the euro, at the present moment, we broke beneath the low of yesterday. If you're trading the daily, a sell would have been triggered because we broke through the low of yesterday. Now, what is of interest to me at this stage is we've spoken about looking at breakout and asking ourselves what kind of breakout do we have. So where is the breakout? Where did the breakout occur? So there is our low of yesterday. The first attempt to break out was that candle, and immediately it bounced off that, so failed breakout. And then the bears that had created those two candles resumed the trade. Then it's led to break out beneath that level, which we did with this candle, another pause, and then we had a bear candle. So quickly, these are things that you have to start reminding yourself. Whenever there is any move, ask yourself, is there a measured move? We spent a bit of time on measured moves. Is there a measured move of anything? Is there any trading range that's been broken out of or any level? So up to that point, we broke out, broke beneath the low of yesterday. That from the open to that low, potential measured move. Again, also you say there's a leg one here and a leg two, but the market reached a measured move. So this bounce off here would not have been a surprise for us. It doesn't mean that we're in a bull trend. It just means there's some profit taking that's happening. The most important levels for you to start looking at now is what happens at the 10 moving average. Nothing much, because this was not a breakout of successive bear candles. The 10 moving average comes into place because I use it to almost as a trend line of a fast accelerating breakout. So that's why I would look at that. So at this stage, the 20 market bounced over 20, fantastic. Later on, we have a double top. That's performed. There we still beneath the move and resuming. Here's what's interesting. This is a trading range, right? So if it's a trading range, you don't sell beneath a trading range. You always want to buy low and sell high. But we're not going to buy here because the market is beneath the low of yesterday's, bounced off the 20 moving average. Now this is where you say, okay, I need this thing to set up quite neatly so that I can find ways to go short. If the bears are strong, I want to be going short. Okay, so we've got to wait. What we wait for, what I'd love to see is bears. So very minor break beneath that earlier low, still good enough. I'd love to see if the bears can put a couple of successive candles here. Good. Then they can come back and test the low of the trading range. And I get a setup there, happy to go short at that point. If we just kind of trickle down, the bull candles, bear candles, bull candles, don't do anything. Just wait. But wait for how long, George? It's a question you should be asking. Another major move. Okay, if the market breaks beneath a trading range, it might get to a measured move. So it's quite possible if we don't get our successive candles, market can just trickle all the way down here, which is fine. Don't jump into it, okay? Because now you gotta wait and say, okay, what happens at that level? Are we gonna accelerate down? If we do that, So wait again for the pullback and get our width trend set up. If the other scenario, of course, market could go back up here and give us a lower high or another double top, then we can look to start to trade. So beautiful setup, bearish at the moment. If we get something happening and we have bulls coming back into the market and breaking above this level, which is resistance, it's normal windows can break out above that, follow through, so the whole scenario repeats itself. How long do you get the dashed EMA? John, let me just confirm. I think you're talking about the 10 moving average, right? So this, you just leave it on. That's the dashed EMA. So the solid blue one is 20 EMA. The dashed one is the 10 EMA. So just plug it in and just make it light so it doesn't distract you. Let me quickly see if we can find. Just I'm going to illustrate the point very quickly. Okay, so you can see here we had a breakout. You can see how the 10 EMA is a very close to the price. So that for me indicates strength. In the moment that's broken, the strength of the breakout is not as strong. Here's a nice one. Here's a nice one. So there we have bear candles 1, 2, 3, 4, breakout candle breaking out beneath the moving average, closing near its low, follow through candle attempt by the bulls to reverse. At some point, the market went up and tested that 10 moving average, and then the bears resumed again. Now, because of that test and of the tail there, you wouldn't want to buy that. I mean, sell it because the tails indicate bulls buying into the close. So the bulls are strong. So here, bulls bought again. Then the bulls tested the 10 EMA again and it failed. So if you're in the market, there is a trade you would have taken comfortably. Take that trade. You gotta find where to put your stop. Best stop is at the beginning of the breakout. Or if you want a little bit more aggressive, find the 50% pullback, because 50% pullback tends to get tested. Just put your stop above that. Then you can do a measured move and see if the market gets to there. These measured moves are really classic. Let's take a look at this. So if you've been in the market and you've seen all of that and you're trying to get in the market, and you gotta say to yourself, how far can you go? The market can always stand there, That's why we talk of 60% probability of success. But if you take that and if you put your stop up there, okay, 15 pips, and if you're going for a measured move of just above the measured move, that's a one-to-one trade. Those are trades that you teach your kids, right? Those are trades that you teach your kids. And if we just talk about this particular one, if you had taken that and seen that the measured move and everything else effective in, and if the market had so you took your trade here, and if your entry candle had come to this low and bounced off that and immediately reversed, okay, you have a choice because your stop is there. Wait to see what happens at the 10 or at the 20. Okay, wait to see what happens at the move at those dynamic levels of resistance. That's what I always do. That's why we put our stop at a technical level. We don't just put a stop, above a candle unless that happens to be a technical level. So you put your stop up there. If it bounced off there and come back to your, so you took your entry there, turned, you have been a slight loss, but your stop is there. Hold onto the trade. Don't come out of the trade. Hold onto the trade, and the market will then just continue to put successive bull candles. Then you make a trade management decision where when I get successive candles, I know okay, double bottom which I wasn't expecting. My stop's likely going to get hit. It's closed above the moving average. There's a follow-through candle. then I just close the trade. So trade management, live trade management is absolutely, at least for price action trading. If you go away and let your stock get hit, that's fantastic. So when that happens, you lost rate, you're doing the right thing. So I just want to show the 10 moving. So there have been other opportunities there for you to trade. Okay, so that's where we are with the euro. Let's if you're in the market after we've gone, just keep those things in mind. Quick look at the CAD, or the CAD today. I'm hesitant to jump in because of the news. If my forex factor is correct, raise statement, USC, etc. It's like three red news. When that's going to happen, if I'm taking a trade, I have to be super cautious to take it out, because when those announcements are made, market just moves. It will set some point into readable price action, but you don't want to get caught in there and get stopped out and sell when it's trying to get in. Okay, how do I make it? So if you just click, just do a right click on the indicator, go to MA10 properties, and go to and under parameters, you will see this dash line here. Okay, so select the thin one on the side, and select this one. So you can make it whatever you like, you make it like that. Okay. So make it what appeals to you visually, because it's there, it doesn't distract you, and just keep it on. So we are in a trading range in CAD. I think I said at some stage, one of the things that I don't do now, I was talking to a friend of mine who just started trading, and he says, well, the problem is, you talk so many things, but you don't do them on the charts. Why not? And I said, what do you mean? And he said, it's there in your head now. So I have to kind of slow myself down and tell you what I'm seeing, because I can just look at it and say, okay, we're in a trading range, let's wait. That's what I mean by the trading range. Okay, so we were in an earlier trading range. The most important thing, guys, or the many important things, one of the most important things is you've got to have a strategy. So we're talking of losing trades, refining strategy. You have to have a strategy. You can't, there is so many things that you get taught. You have to quickly start to find what works for you and what everything works. Everything that you taught at ATW works. Okay, traders are trading it and they're making money, but you have to find what works for you. You can't have 100 strategies. Every time I sit in the conferences, when you come to the trading camps, it's fantastic. Everyone is saying something that's like, wow, okay, it adds to my knowledge. I can pick up things in there, but I don't change my strategy. Okay, I don't change my strategy and start to do other things. When I test someone's strategy, I have to do it separately. But I have a strategy. I think I've mentioned to you, there are 5 distinct strategies, and the 6th one, it is a strategy of sorts, but it's a combination of everything. It's how I trade the open. Okay, how I trade the open of every session. The first hour and a half of every session, trading the open is a combination of everything. But it's crystal clear how I trade. So right now, because we're in a trading range, I'm not going to take any trades unless I see the setup that I want. So there's a double top there. So the news notwithstanding, so let's forget about news. Let's say there was no news that is coming our way. There is a double top that's formed, and that would be the signal to start looking for a trade for the pattern. So you always want to see double top is formed or double bottom is formed. Now let me wait to see if I get a lower high, and I would love to see bear strength. There's no bear strength here. I've seen bear strength, pull back, I can trade that. So at the bottom, double bottom, and let's see bull strength, pull back and trade. But just an alert in terms of the cans, just because of the news. Yes, it's an EMA, exponential moving average. David, I'm in a UK oil long that has been going against me. Now, okay, so talking about the whole point of or the thing we're talking about today, losing trades, refined strategies, and focus discipline. If you are in a trade that is going against you, question number one, is it part of your strategies? Okay, so you can answer that. Are you within your particular strategy or not? Okay, or are you trading someone else says, hey, let's trade long because it all makes sense, and then you jump in. If it is within your strategy, okay, trader's equation comes in, three things: risk, reward, probability. Did you if you manage your risk correctly? So how much are you risking? 1%, 0.5%, 2%, whatever you risk. Where is your stop? Your stop has to be in a technical place. You don't just place random stops. So it's a stop that you look at and say. So for example, let's use this. If for argument's sake, let's say I wanted to take a short trade here. Where do I put my stop? What I gotta do if one of the technical levels is just to do a measured move and say, well, if I'm wrong, let's say I can TM to trigger. If I'm wrong and the market turns against me, I hold on to my trade because I've analyzed everything. I think we should go short. If I'm wrong, the market may want to do a measured move, and then with the measured move, then the trend will resume again. So in that case, if I'm taking this kind of a trade, if my full risk that I want to put to this particular market is 1%, and I know there might be a chance of a measured move, so I'll put 0.5%. Okay, so if I get the market going to do the measured move up here, and I put my stop above it, and I'm not stopped out of the 0.5%, then bear trend resumes. We get the bear trend resuming. We get a pullback, low high somewhere against an EMA, and it's one of those trades that you teach your children or your wife or your grandma. Then you can take that trade, put that upon 5% on, because your risk is 1%. Now it's set up, right? So that's what you do. So if it's going against you in the same strategy and you put your stop in the correct place, your risk is all fine. Don't worry. Okay. If the market is clearly reversed, which means you need to understand trend reversals. That's another thing we talk about all the time. If the market is clearly reversed and the trend reversal is kicked in, and based on that, you should be on the other side, then I'll close the trade. If the trend is reversed and you have absolutely clear that this is a trend reversal. So now, when you analyze those trades, so the trades that are in the buckets where they are losing trades that are in strategy, you want to ask yourself, which strategy was I trading? Okay, so you've got your strategy written on a piece of paper. Which strategy was I trading? Okay, and once you have that, if everything was exactly as per strategy, that's fine. Give yourself a big tick. That's where we have to trade. So that's perfectly fine. Then if you analyze on the other side trades that are in the bucket of out of strategy, question you can ask yourself is why? Why are you taking that? Why did you take that trade? What triggered you to take the trade? Perhaps it's just part of the strategy that needs to be refined. So it could be one, it could be your psychology. You just is moving, and it's almost to my strategy. Let me just jump in, then it reverses. Then there's a problem there, because you are saying to yourself that your strategy is not refined. Your strategy, you can't trust your strategy, because if you trusted your strategy, just sit there, bite your nails, and just say, just need one more candle, And a lot of times I catch myself that just one more candle, and one candle doesn't come. It's like, okay, And when it comes and it presents itself, then you just have to take the trade. There is no questions asked. No turn and now say, let me just wait a little bit more and confirm that it's moving in my direction. Then we trade in the strategy. We trade in our emotions. We trade in. We're trying to get confirmation from the market, and there's a lot of fear and everything built in that, and we don't want to do that. So why are you doing that? And then why don't you stop it? Why don't you stop taking those trades and go back to your strategy? If your strategy is not clear and it's not set up, go back and look at the chart. This is what the strategy says. Look at the chart. Just flip back. Depending on what time frame you're trading. I mean, on the 5-minute time frame, I just probably have to go back just 4 or 5 days, if at all, to see that, okay, no, I'm fine. I just have to be patient. I may sit and sit and sit, but if I'm there when it sets up and I execute it, it's really going to be good. So, which strategy am I trading? For the ones in the losing trades in the strategy session, you have to know which strategy. Okay? And you shouldn't have in a 5-minute time frame. I don't think you should have more than 5 different strategies that you can trade, because it can get confusing. I'm trading 4 markets at the present moment. I've gradually built up to it, and I'm comfortable with that. If you're taking things out of strategy over and over again, and it's out of strategy against a particular strategy, maybe you're too slow or you're rushing into it, then you can do an assessment, right, of the strategies and see if you need to refine your strategy, or if you need to be honest with yourself. It's just you and the laptop and the computer screen. Be honest with yourself. If there's things that you need to deal with yourself, inside of yourself, that fuel you to take the wrong things, then deal with those things separately out of the trade, right? Because that means it's a discipline thing. Let me just talk. Let's the other chart, and I'll talk a bit more about discipline. Okay, so this is the year. So you probably could be saying to yourself, well, what happened here? I'm sure that now you can see, even if I don't put it in the measured move, there's a trading range there. So there's a trading range. Market broke above that. That's a good breakout. There is a breakout candle. There is a follow-through candle. Excellent. Really, really good breakout. Now, if you're looking at that, you would have said, okay, there's a breakout. Why is the market turning here? You have seen that the market got to a measured move somewhere about there. So that's fine. It could be profit taking. So at this particular moment, with the profit taking having taken place, let's put it here, because I want to show something quite relevant to what we're talking about. So some of that high. So there is a measured move, profit taking, pull back. Now the moving average is kind of bent and started turning down because of the subsequent price action. But at this point in time, it was a rising moving average, and that pullback and that setup, right? That pullback and that setup would have been close to the moving average. So for me, breakout pullback, that's what I call a high one phase pullback to the moving average. I would put it there. I would one of my strategies, my breakout strategies, I don't trade the actual breakout. I wait for the pullback, and I want to trade the first resumption of the trade, I would have put an order above that. And where do you put your stop? You put your stop down here at the beginning of the breakout. If you're ultra conservative, you put it down here. So here's the classic one. We've taken the trade, it have been triggered, and immediately it fails. Okay, and it fails, it comes back, does bounce back at the 10 moving average, gets to the 20 EMA, tries to bounce back, fails, resumes, going sideways, creating a lower high. At that particular stage, you can either say, okay, I'm just going to wait and see. I'm already almost close to stopped up. Maybe the market turn here, I don't get stopped out. Fantastic. If you didn't exit when your high one failed, we haven't spoken about the 10. So when that fails, let me describe it. Forget about the 10 high one. That's the 10 using price action. But you get a breakout, you get a pullback, and that's a legitimate trade. Now, why am I trading that? I'm saying the bulls were able to with a strong candle follow through breakout. The next move, profit taking, fantastic. Not necessarily a reversal. So I'm expecting that this is the leg one, about a pullback in leg two. And we have spoken about leg one, leg two extension. At the same time, we spoke about major moves. So at that stage, I'm saying that's the first leg of the move. And there is a pullback. So I'm going to put an entry, and I'm going to expect that there's a 60% chance that the bulls want to get to that, which would give me one-to-one entry. So it's absolutely perfect trade in terms of the trade breakout strategies. So I would have taken that, but guess what happened? It failed. Okay. At this point in time, I would have gotten out of the trade. Why? Because if you're taking the first pullback up, what you are expecting in your strategy is acceleration up, or if it's a bear breakout pullback and you're taking the first pullback, you're expecting acceleration down. You don't want it to go sideways and fail. Immediately, alarm bells go off and say, no, this is one of those trades that I'm going to lose. It's in the bucket of trades within the strategy, okay, but I'm going to lose it. So I'll trade, manage it, get out at that stage, or if I decide to wait for the moving average, which you can do if you want 20 MA, it might just bounce. Then if it doesn't, you get out. So many opportunities to get out without losing the full risk. But if you left it, which is perfectly fine, because when you set your strategy and your risk, you are setting your strategy and your trader's equation, risk, reward, profitability. You set it on full loss, right? You set it on getting your 1% or 2%, whatever you put in, the stop being hit. That's how you assess the profitability of the strategy. You make a lot more profit by managing, by trade management. Okay, so my strategy would have stayed 10 of these as they were okay. I'm going to win the breakout pullbacks, a high probability, 60-70% chance I'm going to win the trade, and I might have an opportunity to add in a little bit more. I think I showed those last about those profits. You can just add some more in at some first pullback as you get to that level. If I trade money correctly, I make trade manage ones that make losses, instead of losing 1%, which is acceptable. I lose 0.25. Okay, so losing on in strategies is perfectly fine. Earlier on, I think I'm in long on oil and it's been against me. So I'm not sure because I don't trade oil. I just trade gold. Maybe at some point I'm going to 5 products I add oil, but I'm just happy with this one resource. Let's say this is what you had, you take trade, and it is going at a fine. That's what I was emphasizing. It's a trade that is within strategy. There is absolutely nothing to do. You just sit back and just let it be. Is it fun to lose money on trading? Is it awesome to win money on trading? You should just, you should be zero, you should be neutral. It's your strategy. You can't be continually. That's then there's something wrong. You are trading your emotions, and you're not going to enjoy this job. You're not going to enjoy what you do here. Just let it play out. Your fun should be in waiting to see the strategies unfold. Say, okay, I can see what's happening. I'm understanding it. I can wait, or I've been waiting, and nothing is coming up. Why? What do I do? But it's clear there's nothing in our strategy. That's the fun. That's what you must enjoy. That's what you really must take pleasure in. So that's a good thing that's happened for us to just have a look at that. So what are we doing here? We're going to wait and see what happens. Okay, so that kind of failed. That's not relevant now for my analysis because I was for that move, but we do have a larger trading range forming here. So it's always interesting for you to come back in the day and see if this thing's see what happens. So if the market breaks beneath here, you're likely to get down there, which is fantastic. So you don't have to do anything here. Because if you do get the breakout, strong candle, follow through, wait for the pullback. If it's a very strong pullback, it's going to bounce off the 10-year, take the trade. There is where you want to go for the profit. Okay. And if the bulls do breakout above the trading range there, again, same thing, they might be trying to go for a new high. This is going to go to a new low. Again, based on the breakout side, you wait for the breakout, pull back and trade. That's trading according to strategy. You don't want to be jumping in here and say, I think it's going down, let me jump in. You're going to struggle with that. So let's look at gold. And just before we look at gold, I want to just share a few more things. I was talking about losing trade, focus, discipline. Question I got to ask you: do you know how to execute a strategy, any strategy? And that's something that if you want to do an exercise on yourself out of this, the week until you catch up again, ask yourself: do I know how to execute a strategy? And here's how you can test yourself. Can you bake a cake? Can you bake a cake? Can you say, I want a vanilla cake or chocolate caramel, whatever it is, cake. Can you find the recipe? Can you find the ingredients? Can you bake the cake? Will it come out the way it ought to be? Because if you can bake a cake, it means you can take a strategy and it's defined steps, and based on that, you can then execute the strategy and produce the outcome. Take something simple. In my house every Friday night, so if you come visit us on a Friday night, you can expect one simple meal: popcorn. Movie night at home, popcorn and chocolate and all these things that you put in. So I'm the popcorn guy. I'm the guy who makes popcorn. But a couple of times, I found myself, what's that smell? It was burning. And I'm like, how is that possible? Because I just come in and just chuck the oil and just wasn't paying attention to that. There is a strategy to getting a crisp, crunchy popcorn that's not soggy or smelly. Can you execute a strategy? Because if you can bake a cake, if you can pop corn, it means you can follow a strategy. All it means is someone is going to the extent of laying it out and they say, these are the rules, that's what you follow. You don't kind of say, listen, just beat up the eggs, chuck the sugar, let's put it all in and hopefully a cake will come out. It will not come out. That's why it's absolutely important. I cannot overemphasize for you to have a crystal clear strategy with detailed steps that stays next to that you look at. And if you have to write it out again, write it out. Don't keep it in your head. I write my strategy down. It's absolutely written. When this happens, what to look for. When it bounces off here, is what you must do. You know, that's clearly defined for me. That's how I trade. Now, if you can bake a cake and everyone is happy, can you do it over and over and over again? Can you take that recipe, bake a cake tomorrow? Take the recipe, bake it the next day. Take the recipe. Just every day they want cake, and you just do it over and over and over and over again until it is so embedded in your whole mind. In fact, in your neurology, in your whole neurological system, your strategy is backed in. So when you come and look at gold, for example, just by looking at gold, you could say, oh, there is market well. There is a bear candle breaking beneath the moving average. Do I get a follow through candle? Fantastic, a bear candle. There is a subsequent candle. Then the market starts to turn. It's bouncing off the high of yesterday. But what am I looking for? Strong candle. Let's see what happens with the 10 moving average. It doesn't get to the 10, it's going sideways. Then I get a test of the 20 EMA. 20 EMA test. Okay, inside candle follow through. I'm going to execute the trade and put the stop up there. You can do that. Okay. Then, leg one, leg two, measured move, all of that stuff. Now we're at a measured move. So you've got your strategy. Right? This thing is getting you. Okay, you don't even have to put it in. There's a leg one, leg two. Because you are working so hard on executing your strategy. Okay, the leg one started there, and there. Market didn't quite get there, but got to between the leg one and two and the measured move. Now we're going sideways. It does not mean that we have a bull trend is yet. If the bulls are going to charge, honestly, full breakout, test of high of yesterday or to the EMA, then take a trade, go long and put the stop here. But the point is, if you're losing trades that are out of strategy, okay, ask yourself why that is happening. Okay, either your strategy is not properly refined, or there's things that are happening within your own mind and your own psychology that you need to deal with. And if you speak to the guys at the office, Angela, them, and say, hey, I want to talk to Dr. George about my trading psychology, they'll set you up, and we can do work purely on trader psychology. That's another thing that I'm passionate about, that I'm super good at. So we resolve that, then you stop doing that. Okay, progressively. I still make mistakes, but okay, I know that trade out of strategy, it happened consciously because I was being foolish. So that's fine, because you're being foolish, you shouldn't do that. You're losing money because of foolishness, so don't do that. And then on the other side, we spoke about that. Good if it's a strategy, but then now we want to go back to what is our strategy, because once we know our strategy, then you can do the same exercise yourself on your winning trades. If you've got trades that you've won that are out of strategy, there's a big trader psychology thing that needs to be dealt with. If then the trades that you've won that are on strategy, fantastic, happy. Then you want to embed your strategy, you want to be able to bake the cake over and over again until it just becomes a part of who you are. Now, I wanted to talk about gold very quickly. There's something that's we're talking about price action, right? And price action is, we say the markets are fractal, Fractal. So whatever price action you see on any time frame repeats itself. You would know that you're looking at a 5-minute time frame of gold to the US if you didn't see that. Okay, you wouldn't even know if this was oranges if you just saw the price action chart, whether it was a daily or hourly, because the patterns will pick themselves. So let's just go to daily. I mentioned this because last week, 14th. Okay. So last week we were in this particular day as it was unfolding. And I had mentioned, we're talking about price action patterns. That's what you want to see. There's a double bottom. We're talking, I think, of double bottom. I always want to see the pattern. Can you enter a trade here? Okay, I want to see the double bottom. I want to see confirmation of strength by the guys who created it. That's a bulls. Okay, bull candle, bit of hesitation on the 20 EMA, bit of a problem. Follow through the next day. Now, I would have been looking either for a pullback to give me a higher low here, but we went up and we got the higher low here. Okay, so firstly, could you take the trade here? You could if you wanted to. That's not our trade, because you take the trade there is a higher chance, 50-50 chance, let's put that way, of the market turning and trying to do a measured move. Okay, so if you're going to take immediately after the double bottom, where would you put your stop? The correct place to put your stop is not underneath here. That's not the correct technical place. You have to do a measured move and see if you're comfortable on any time frame to put your stop at this level. Okay, so entry here, put stop in case market. I mean, beneath, you have to put it beneath the measured move because the market might want to come test the measured move. But I don't do that. I see the double bottom and I say, okay, fantastic. Bulls have created a double bottom. Let's see if we get a higher low. So we were talking at that stage, and I said, well, that's a higher low, but now let's see if we get triggered in. That day we did not get triggered in. So that immediately would have posed a problem for me to say, okay, the bulls are strong. Created double bottom. We hesitated moving average, but then they follow through. Okay, paused again. Bull candle reversed. Bear candle. Now they've set up. Why are the bulls not strong enough to trigger the trade? Okay. It's almost in a way like that trade that we looked at where it's a breakout, pullback. I want the high one. I want to see successive bull candles in the pullback. So that will have been a problem, not a trigger there. Now, if I'm triggered in a trade, whatever time frame, I take off the trade. I don't leave it in the market. So we have taken it off, end of the day, and boom, the next day, those who stayed were triggered in. I have no problem with that. That's not the way that I trade. So you have missed that particular trade, and the market has gone up. Now, okay, we're breaking out now above the high of that double bottom. Okay, just broke above it. We forget about this red line. That's yesterday's low. So that will not have been there. But that dotted blue line is low of this level that we broke. So we broke beneath the low of this level that will be tested again here, there. So good, there, bulls, and there is a follow-through candle, not very strong. Why are the bulls failing to give us successive strong candles? Okay, so what can happen? The bulls can give us another strong candle. But I would not have been in this particular trade because nothing it's set up, but I haven't had the trigger. That makes sense. There's a double bottom, and I'm waiting for my higher low. Did it trigger? Okay. This would not have a higher low because I always want to see the breakout above the moving average. There is a breakout candle above the moving average. They'd love to see a follow through and a pullback. But also, fact that you see as a bull candle doesn't mean it was a good trade. To me, it would not have been a good trade because you don't want to buy above a bear candle. Okay, what I would love to see, if this had been a bear candle during the day, and then it reversed or ended up like this candle here, this had been here, fantastic. That would have been a trade to take, and if you get stopped out, that's fine. So the point here is. You could have taken a trade not in strategy, which is not good. You're analyzing your winning trades, not in strategy. When you do that exercise, you say, okay, I didn't get triggered here. I'm going to leave it in. Let's see what happens. Be triggered in and be in the profit, a good stop, whatever. That would be a winning trade out of strategy. You don't want to take those trades, guys, because those invade your success ratio. So those are probably 20% success, 30% success. Yeah, they do work, but you lose a lot more times than win. And we don't want to do that. We want just to wait. So you'd have said, okay, let me just wait and see what happens. So what am I waiting for, particularly if I was actually trading on this time frame? I want to see, I want to see a little bit more bullish price action in the pullback. If the bears come in and give us a strong break, if it's slow, then I want to get a double bottom somewhere within here in the signal candle. Right now, there's nothing for me to trade here. I can't trade this. Is a high one because I made my success in booking in the pullback. So that's I think it was worthwhile looking. This is on the daily time frame. But of course, if you trade the lower time frame, there is a lot of things that happen in the day that can allow you to trade. So quickly look in the remaining minutes. Just check there's no more questions in the chat. Okay, so euro doesn't go on since we spoke. Remember, we put in that trading range and the measured move and say if the bulls came back into the market and it's just going to be a bullish breakout of this. We need to see breakout and pullback. The bears are strong. We want to see if the bears break beneath this and what happens here. So even if it trickles down at this stage, there's no bad trade to take at this stage. Okay, what we'd like to see is successive bear candles. There will be profit taken at this level, which is fantastic. That gives us the opportunity to watch the market pulling back. If we get successive bear candles to give us a first entry here in the breakout, which we can trade going short. CAD, again, notwithstanding the head to the news, but this is interesting. So here, if the bulls are strong and they give us a successive, so there's a breakout candle, we want to see another bull candle which would confirm the breakout. When the market turns here, we're not surprised because there's a level of resistance here. Then there will be a pullback to a 10-moving average. And depending on how long it takes, then more into that new zone. I wouldn't trade it, but if you set up nicely and want to worry about the news, you can take it and see how far you can go. But if there wasn't news, let's see if you get a breakout. There's a level of resistance, profit taken. Let's see if you get pullback or a follow-through breakout to a new high and look to take the trade. Yen going sideways. So if you're in that trade that we spoke about, if you had held onto your trade and it went against you, and so well, let me see what happens. You're still in the trade, right? It's very close to 1%, 2%, whatever. But you're still in the trade, so you just let me see what happens. And if it starts to go your way, fantastic. Then wait until you get new price action above it to the trade, pull back, you might get another opportunity to go long. So there's a classic thing. If it's within strategy, you can just wait to it's okay to get your stop, let your stop get hit. It's within strategy, and you probably should learn to allow that to happen. That's part of it, until you are comfortable with your read of the market. I would have stopped out of this market, and I would have lost whatever, I don't know, 4% of the week. Then I'll be waiting to see what's happening here. So this could be, it's almost a double bottom, bit of a higher low. I'm not going to trade that. Love to see if you get a couple of candles, a higher low somewhere within there. Then you can look to take the trade. Your stop, if you take in that, has to be way down there. Okay, so that's one to look out for and see if we get successive bull candles in the pullback. All right, guys, fantastic. I sincerely hope you enjoyed it, and I did, and look forward to seeing you again next week. And signing off right now. Thank you, guys.